Mountain Man Brewing Company Case Study by Juliana, Kelly, Orson, Giovanna, and Ryan. Mountain Man Brewing Company was founded in 1925. Their product is Mountain Man Lager, and their marketing is geared towards blue-collar men around the age of 45. Mountain Man Brewing is known for being strong and for its loyal customer base. They face market challenges when it comes to their 2% annual decline. Their population is shifting to light beer, and the competition rising from larger breweries is competitive. Strategic considerations should include launching the Mountain Man Light beer, alienating their core customers, and investing in marketing for their company. Some key decision points should include launching a light beer, researching the preferences of younger drinkers, and balancing the brand with the trends. Some recommendations could include integrating a new product carefully. Key case issues. Mountain Man Lager, the company's flagship product, is experiencing a decline in sales due to changing consumer preferences and increased competition. The beer market is shifting towards light beers and is preferred by a younger demographic who can view them as healthier and more modern. The light beer market is growing, driven by consumers aged 21 to 27 and health-conscious individuals. Mountain Man Brewing Company needs to assess whether it can successfully attract this new demographic without losing its existing customers. There are some financial implications. They can have a significant loss involving developing, producing, and marketing a new light beer. There is uncertainty about whether the investment in a new product will yield a sufficient return to justify the expenses. The beer industry is highly competitive, with many established brands dominating the light beer segment. Mountain Man Brewing Company must determine how to position Man Light in a crowded market to differentiate it from its competitors. Introducing a new product could complicate production process and require additional resources and capacity. Managing distribution channels and ensuring practical sale efforts for new existing products can also be challenging. There is a risk that Man Light could cannibalize sales of Mountain Man Lager rather than attracting entirely new customers. Mountain Man Brewing Company must find a balance between protecting its core product and pursuing new growth opportunities. Conducting thorough market research to understand consumer preferences, potential demand, and competitive dynamics is essential. Assessing the feasibility of launching Man Light in terms of production, distribution, and marketing capabilities. Developing a marketing strategy that clearly communicates the value proposition of Man Light without undermining the traditional image of Mountain Man Lager. Effective promotional efforts are needed to introduce the new product to the market and generate awareness and interest. The Mountain Man Brewing Company case presents a complex decision-making scenario. The company must consider the potential benefits of launching a light beer while weighing the risks to its established brand identity and financial stability. Strategic, market-driven decision-making supported by thorough research and stakeholder alignment is crucial for effectively addressing these issues. Mountain Man Brewing Company's core components can be split into two categories: functional and emotional. The functional components include one beer option with a specific taste. This specific taste differs from major domestic brewery companies and offers a distinct, flavorful, and bitter-tasting brew. This beer selection is affordable and accessible. It is able to be purchased at typical places like bar and beer distributors, as well as liquor stores and supermarkets. The emotional component of this brand involves its roots of being a family business and independent brewery. The drinkers of Mountain Man Brewing have a certain level of trust with this beverage, as Mountain Man Brewing Company avoids lifestyle advertisements and gaudy visualizations in their marketing. Primarily, the company focuses on word-of-mouth marketing and reinforcing their brand trust. The distinction of Mountain Man Brewing Company products versus their competitors focuses on the history, authenticity, brand awareness, and loyalty and distinct flavor. Their beer offers the original design with a picture of a coal miner, allowing for easy recognition and relatability. Additionally, their customers authentically relate to the company's humble beginning and consistent offerings. The company is aware of who they are marketing to and stay conscious of this demographics preferences, needs. Compared to the competition, the alcohol percentage is slightly higher, another distinctive feature for the beer. As stated previously, Mountain Man Brewing Company is aware of their target markets: blue-collar men within middle to lower class over the age of 45. These customers also predominantly live in Illinois, Indiana, Michigan, Ohio, and Mountain Man's native area, West Virginia. When realizing that working within beer distributors with large brands was challenging, the brand acknowledged that distributing with off-premise locations would serve the company better. Mountain Man Brewing Company's promotional strategies were not necessarily modern. Their focus were on grassroots marketing and word-of-mouth marketing. These two techniques allowed consumers to aid in building brand trust, but did not necessarily support an expensive market campaign. Mountain Man Brewing Company also avoided lifestyle advertisements typical of competitors in order to keep brand relatability. As stated before, the company also targeted off-premise locations to distribute due to difficulties with competitors and consumer preferences. There has been a shift towards light beers among younger consumers and a declining popularity of traditional lagers. As explained in Chapter 1 by Kotler and Keller, marketing requires understanding the needs, wants, and demands of different customer segments. The craft beer market is growing and offering more diverse options. There are larger beer companies investing in marketing and innovation. Kotler and Keller explain in their text the importance on focusing on differentiation and positioning. Recession is also impacting the discretionary spending. The price sensitivity among customers is affecting premium brands. Economic environments influence consumer buying behavior and brand strategy, according to Kotler and Keller. There's limited marketing budget restrictions for the brand reach. There are distribution challenges in expanding beyond the regional market. Kotler and Keller emphasize the effective marketing channels and integrated marketing communications are essential for any brand success. Core customers are aging and consuming less beer, and there is difficulty in attracting the younger generations. Mountain Man's Lights feasibility. First, we will use the case study in the Mountain Man 2005 income statement to determine the price per barrel Mountain Man gets for their lager. Within the case study, it reports that in 2005, Mountain Man sold approximately 520,000 barrels of Mountain Man lager. This equated to $50,440,000 in net revenue for 2005. Dividing the net revenue by barrels sold, we determined that Mountain Man lager is sold for $97 per barrel. In the case study, it is stated that Mountain Man Brewing Company will receive the same price per barrel for Mountain Man Light as it does for the lager. Thus, each barrel of Mountain Man Light will also be sold for $97. However, the variable cost per barrel of lager and light may differ. The contribution margin for lager is $30.07, while the contribution margin for light is $25.38. There will also be certain fixed costs that come with the launch of Mountain Man Light. In 2006, year one of Mountain Man Light, there will be an extensive 6-month marketing campaign to create brand awareness in the East Central region at a cost of $750,000. There will also be annual incremental selling and general administrative costs of $900,000. This means in order to break even within 2 years, Mountain Man Light must generate a profit covering both the associated launch market and the incremental administrative costs totaling $2,550,000. To find what is required of Mountain Man Light to break even in 2 years, we take the total cost divided by the contribution margin of Mountain Man Light. This comes out to be 100,473 barrels of Mountain Man Light sold in the first 2 years. This would amount to $9,745,881 in revenue needed to break even. Next, let's dive a little bit deeper into Mountain Man Brewing Company's projections of light beer market overall. In 2005, 18,744,303 barrels of light beer were sold in the East Central region. The number of barrels of light beer sold in this region is projected to increase by 4% annually. Mountain Man Brewing Company expects to capture 0.25% base market share in 2006. Mountain Man Brewing Company expects to increase its market share of the light beer market by 0.25% each year, meaning in 2007 it expects Mountain Man Light to capture 0.5% market share. This equates to 48,735 barrels of Mountain Man Light sold in 2006 for a net revenue of $4,727,313.22. In 2007, Mountain Man Light is projected to sell 101,369 barrels. This would mean in the first 2 years, Mountain Man Light should sell 150,104 barrels. These figures surpass the needed 101,473 barrels to break even in the first 2 years. You can see from the table, Mountain Man will lose $413,100 in 2006, but will earn $1,672,750 in 2007. Overall, Mountain Man Light will gain $1,259,649 in the first 2 years, making the launch profitable. Again, this is all assuming no cannibalization of the Mountain Man lager sales. However, as we know in life, nothing happens in a vacuum. Cannibalization is a very real risk for Mountain Man Brewing Company. Sales of Mountain Man Light very well may cut into sales of Mountain Man Lager. If profits from the light beer are less than the losses from cannibalization of the lager sales, this is not a smart venture. I will calculate 2 different scenarios of cannibalization mentioned in the case. First, a best case scenario of 5% cannibalization in lager sales. Second, a worst case scenario of 20% cannibalization of lager sales. If 5% of Mountain Man Light sales cannibalize the Mountain Man Lager for every 100 barrels of Mountain Man Light sold, 5 barrels of Mountain Man Lager are lost. The contribution margin lost from Mountain Man Lager is 5 barrels multiplied by $30.07, which equals $150.35 lost for every 100 barrels of Mountain Man Light sold. Then you can calculate the net contribution margin by multiplying Mountain Man Light's contribution margin by 100 and subtracting the 150. This net gives us the net contribution margin of $2,387. Now we can calculate the effective contribution margin per barrel. The effective contribution margin per barrel of Mountain Man Light is $23.88. After that, we calculate the number of barrels needed to break even. We know there is a total contribution of $2,550,000 from marketing and the administrative costs. Divide this number by the effective contribution margin to get 106,784 barrels sold over the first 2 years to break even. The total market sale for 2006 and 2007 combined would then be 39,767,913 barrels. Mountain Man Brewing Company would need to achieve approximately 0.27% market share to break even, given that Mountain Man Brewing Company expects to have a 0.25% market share in 2006 and 0.5% market share in 2007, averaging a 0.375% market share over the 2 years. They would capture enough to market share to more than break even with 5% cannibalization. We will now follow the same logic as our previous calculation, but instead of 5% cannibalization, we will look at the worst case scenario of 20%. First, we calculate that there is $601.40 lost for every 100 barrels of Mountain Man Light sold. The net contribution margin for 100 barrels of Mountain Man Light sold will be $1,936.60 per barrel. This equals an effective contribution margin of $19.36. Knowing that we once need to cover the $2,550,000 from marketing and administrative costs associated with the Mountain Man Light, we find that we will need 131,714 barrels of Mountain Man Light to break even, given a 20% cannibalization. Mountain Man Brewing Company will need a 0.33% market share to break even. Again, given that Mountain Man Brewing Company expects to have a 0.375% average market share for 2006 and 2007, this would be enough to break even. If the projections are correct, and Mountain Man Brewing Company is indeed able to capture a base market of 0.25% of the East Central Region light beer market in year 1 and increase by 0.25% each subsequent year, this budget is certainly appropriate to launch Mountain Man Light. Mountain Man Light will lead to profitability by year 2 in 2007. This trend of profitability should satisfy all the key stakeholders within Mountain Man Brewing Company. Some pros and cons of launching the Mountain Man Light. This can attract the new demographic, which will appeal to a younger demographic, particularly those aged 21 to 27, who prefer the lighter beers over the traditional lagers. By entering the light beer segment, Mountain Man Brewing Company could capture a portion of the growing market for light beers, a significant and expanding segment of the beer industry. It also can increase revenue growth. Introducing Man Light would create an additional product line, potentially increasing overall sales and revenue. Having multiple products can stabilize the revenue streams, reduce dependence on the core product and Mountain Man Lager. Launching a light beer could help modernize Mountain Man Brewing Company's brand image and make it more relevant to young consumers. A diversified product portfolio can appeal to a broader audience, enhancing brand visibility and appeal. Competitors in the beer industry are continuously innovating. Mountain Man Brewing Company can stay competitive and relevant in the market by launching a light beer. Light beers can often be perceived as healthier due to the lower calorie content, aligning with current consumer health trends. Some cons of launching Mountain Man Light. Mountain Man Brewing Company is known for its robust and traditional lager. Introducing a light beer could dilute the brand's identity and alienate loyal customers who value the conventional Mountain Man lager. Longtime customers might perceive the launch of a light beer as a shift away from the Mountain Man Brewing Company's core values, potentially leading to a loss of brand loyalty. Mountain Man Light might cannibalize sales of the Mountain Man Lager if existing customers switch to the new product rather than attracting entirely new customers. Marketing and sale efforts might be spread too thin, impacting the effectiveness of promoting either product. Developing, producing, and marketing a new product requires significant investment, which could strain Mountain Man's financial resources. Man Light is not guaranteed to succeed, and the investment might not yield the expected returns. Introducing a new product line could complicate the production process and logistics, requiring adjustments in manufacturing and distribution. Additional resources would be needed for the production, marketing, and sales of Man Light, which might detract from efforts on the core product. Before making a decision, Mountain Man Brewing Company should conduct comprehensive market research to gauge the potential demand for Man Light among target demographics. This should include a detailed analysis of the competitive landscape, production capabilities, and financial implications. A careful consideration of these factors will help Mountain Man Brewing Company make an informed decision of the potential launch of Man Light. A limited or pilot launch in select markets could be a prudent approach to test the waters without fully committing resources. This would provide insights into consumers' acceptance and the product's market potential while mitigating some risks associated with a full-scale launch. If Mountain Man Brewing Company decides to proceed, a strategic marketing campaign should be developed to differentiate Man Light from Mountain Man Lager, emphasizing that the new product complements rather than replaces the traditional offering. In conclusion, Mountain Man Brewing Company is a historic brewing company seeking modernization with a niche consumer base. The expansion into other beer selections would diversify their company and open avenues to increase revenue and allow growth in the company. There are also cons to weigh, including brand dilution, market cannibalization, financial risk, and operation challenges. With growing prevalence of a diverse beer market, including craft breweries, imported beer, and domestic competition, Mountain Man Brewing Company will have to deliberate in their future business tactics.